This is Perspectives, a bi-weekly investment podcast brought to you by Escala Partners. In a world cluttered with information, Perspectives cuts through the noise to bring you insights and commentary on global financial markets, economics, and geopolitical news and events.
Welcome to this episode of Escala Perspectives. I'm Tracey McNaughton, CIO of Escala. I'm thrilled to welcome today's guest, Lane MacDonald, Chief Investment Officer at SCS Financial. SCS Financial is a prominent wealth and investment management firm headquartered in Boston, Massachusetts, where Lane is joining us from today. They were founded in 2002 and today manage over $40 billion for ultra high net worth individuals, families, family offices, and institutional investors. Importantly, SCS is one of the largest partner firms of Focus Financial Partners. This is important because Escala has now officially joined Focus alongside SCS and the other partner firms. We are proud to be part of the Focus family. So welcome, Lane, to our Perspectives podcast.
Thank you, Tracey. It's a pleasure to be with you.
Let's get started. Today, we're going to talk about public versus private markets. And I think that it's a timely discussion because not only have public markets reached new all-time highs in the US, it happened again last night, our time, but the lines between public and private markets are rapidly blurring, prompting investors to rethink how they allocate capital, how they manage risk, and pursue returns between the two. So we'll unpack all of this and more, but Lane, let's start by defining what we mean by these terms. How would you define public markets and how does that differ to private markets?
So public markets are companies that trade on exchanges, New York Stock Exchange, NASDAQ, and certainly also Europe. And so I think about it in the context of public equity-wise, US, EFA, or developed foreign markets, and then certainly emerging markets. And whereas, so all of those stocks can be traded on a daily basis, whereas private companies are those that are much more difficult to access, right? That are privately held, maybe owned by a family, maybe owned by a group of entrepreneurs. These days, private equity firms play a role in owning those companies. I'd say that one other key distinction for me, Tracey, to that question is the number of companies and the opportunities. The private equity markets have actually, not from a dollar standpoint or value standpoint, as you said, they've reached highs, continue to reach highs recently, but from a number of companies standpoint. So there are less than 5,000 US market public companies. There are more than 7.5 million private companies. So that's the other piece about like the opportunity set, kind of what is different about those two markets being private and public. Not only how they're traded or not traded on an exchange in the case of private, but also the number of companies in each world.
And I suppose too, it's not only the opportunity set is much wider in private markets, but also you're probably getting access to a much more diverse range of companies compared to public markets. We always talk about the US S&P being dominated by the big tech companies. You're getting access to a wider breadth of companies in private markets, aren't you?
So Tracey, very well said, and so true. And oftentimes, as we all know from a historical standpoint, it is those smaller companies, right, that have extraordinary growth to them. Now, we've been had this Mag 7 driven world where there's been real growth from the stock price performance. But when you look at the universe, the smaller companies can compound at very high levels, right, to eventually become those larger companies. But when you kind of are able to invest, when companies are $100 million or $200 million or $25 million in revenue, right? Those companies can grow 100, 200, 300, 500% per year, which is really kind of that inflection point where there really are interesting value creation opportunities.
So let's talk about how the landscape for private markets has changed over the past 20 years, because as you say now, it's a much broader universe. It's become much bigger. And one of my favorite statistics, Lane, is that the number of companies listed in the US has fallen by half since the mid-1990s. So there's been some big changes in this space, hasn't there? What have been some of the big changes, or what are the drivers of that change?
So I think clearly, it's your point, Tracy, like there's fewer public companies, right? And so that pond has gotten smaller over time. And we also see the benefits of private companies where they're staying private longer and not going public. But from an evolutionary standpoint, the private equity world has really matured, right? People have become more specialized. It used to be generalist private equity funds or buyout funds, right? If you break the world down into buyout, growth equity, and then venture capital, three distinct parts of private equity, buyout funds used to be generalists. Given the increasing, but still relatively inefficient, inefficiencies in those markets, but increasing efficiency, the need for specialization has come in. You used to be able to be a generalist, you do a manufacturing company, you do a consumer company, you may do a tech company. Now people have really specialized, or firms have specialized into each of those segments where you really need domain expertise to win. You need to go deeper into subsectors. Where are you in technology? Are you in software, right? What areas of software are you investing in? And so I think the evolution has been in private equity has been a greater need for specialization. And once again, I always come back to domain expertise. When I say that, I mean both from an investment standpoint, but from an operational standpoint. But that's where if you bring those things together, that you really have an ability to generate great performance in the private equity world. But specialization, I think, has been the biggest change over the past 20 years.
How do the risks differ between investing in public companies versus private companies?
I think they certainly differ in a variety of ways, right? In some cases, on the public side, if you buy a stock one day and you don't like it the next day, you're out. Now, with private companies, you're going to hold those companies longer. I think when you get into the mega cap world of public equities, right? I mean, those companies, will be around for a long time. And if you're going to invest in GE, GE is always going to be there. I think in private equity, there are some of those companies that will be around for a long time. But there's also newer developing emerging companies, and particularly in the area of venture capital, right? Who's going to be the next Facebook? Who's going to be the next Apple? Who's going to be the next Meta? Those companies, right, at that stage, early stage venture capital, have greater risk to them, but certainly greater opportunity. And so it ends up being one where depending on where you're investing in the private equity realm, there can be greater risks, but the returns historically have compensated for those incremental risks.
So what kind of returns could, generally speaking, because it is a very diverse sort of area, but compared with public, what kind of returns should investors expect in private?
So I see they frame this in two ways. Number one, if you look at private equity versus public equity over any 10-year period, Tracy, private equity has outperformed, full stop. There's been a meaningful outperformance of private equity, and that's just mean to benchmark performance, right? Not sort of top quartile. And there's great dispersion in private equity in terms of top quartile performance versus mean. But generally, that delta has been in the 300 to 500 basis point range per annum in terms of outperformance in private equity relative to public equities over a long period of time. Now, the most challenging period, historically, there have been a couple, but it's been this last 3 years. In a Mag 7 driven world, with the performance of those businesses, public markets have done remarkably well. Not remarkably well, but extraordinarily well. And so, in many ways, during this period of time over the last 3 to 4 years, public equities are performing very well. But for all of us as investors, when you have a longer term kind of view, private equity has won, and I do believe will continue to win over long periods of time to justify the illiquidity that's commensurate with an investment in private markets.
You mentioned there the dispersion of returns between managers in private, and I want to come back to that. But before we do that, just on the fact that, if you're investing in public markets, if you want to sell, you can sell, in a second and get out. That's not so much the case in private markets and can be seen as a disadvantage. There's a liquidity risk that you're taking there. But looking on the other side of the ledger there, the fact that you can't easily get out of private markets, does that, in your mind, encourage long-term thinking? That I've seen a statistic that the average holding period of a stock in public markets is something like 7 months versus in private markets, it's 7 or 8. or even longer, years. And so it's longer term thinking in private markets by design, perhaps, but it encourages more patient capital. What are your thoughts there?
Once again, very well framed, Tracy. I'm a believer that duration is the greatest advantage that exists in markets today, right? And with duration, the public markets are so efficient, very hard to find alpha. But if you have the benefit of duration and can handle illiquidity, you can do things differently. You can take a longer term view. You can be contrarian, right? You can kind of build and grow businesses. I do think that illiquidity is a really help in terms of being long term, being patient. And particularly during periods of volatility, it's extraordinarily important not to be reactive. I've been an investor for a long time now. It's very important to be thoughtful and patient as an investor. Usually a reaction to a short-term dynamic in a market is an overreaction. And I think it's Peter Lynch, who is the kind of famous Fidelity portfolio manager, has said previously, and I agree with this, more money's been lost trying to time markets than has been lost in the down markets. Private equity is a forcing mechanism there that you are going to be a long-term thinker. I'd say for folks who have a component of private equity in the portfolio, there's also a knock-on benefit, Tracy, where your overall portfolio is buoyed by the private equity marks or valuations, which aren't as volatile as public. So if you have a portion of your portfolio in private equity, the public's maybe down, pick it, something happens like in the US Liberation Day, all of a sudden markets drop 10, 15%. But your whole portfolio is not down 10 or 15%, right? Depending on, so I think that ends up providing, I think for many investors who can be reactive, peace of mind to be more patient. And if folks reacted to Liberation Day with US exposures, right, that would have been ensouled, being very concerned, that would have been a very painful decision given what's happened. And so I think private equity can be a wonderful kind of balance in a portfolio to mute some of the volatility and kind of give people peace of mind in terms of, to be a long-term investor, long-term thinker. And once again, I do think it's kind of that piece where from a peak to trough to peak, historically, data, right, private equity has outperformed. Like peaks are higher, troughs are lower, peaks are higher. Again, coming out of downturns when you look at historical downturns. And so I think that's another important dynamic for people to understand in terms of one of the benefits of private equity.
Seen a really interesting chart of yours, Lane, that looks at the importance of manager selection in private equity. And it goes to that dispersion point that over a 10-year period, the difference between the best and worst managers in public equity is pretty small. At best, they're around 10%, and the worst is around 8%. So it's not a huge difference. But in private equity, the difference is substantial. The best are up around 18%, and the worst managers are down around -2%. So the cost of getting your manager selection wrong can be high in private markets. How do you think about your selection of private equity managers?
So what I would say is, first, I was a private equity GP for 13 years, going all the way back. I then joined Harvard Management Company and helped lead and then ultimately led the private equity program at Harvard Management Company. And so everything you referenced is exactly right. I would say when you sit in a position with a meaningful capital base, right, Harvard Management Company had it, and certainly we, at SCS as part of the focus ecosystem have it, managing north of $40 billion, not dissimilar to HMC in many ways from a size standpoint. And you have great relationships, you put yourself in a position to be able to access the best managers in the world. And so, but that's hard work, right? You need to have a team, and we have a 25-person investment team, many of which are focused on privates. We want to meet with every private equity manager in the world, right? And spend time with them. And then through that, our program's been around for north of 15 years. You build relationships with the best investors. And, with that, you're able to really pattern recognition wise, also performance wise, triangulate to where those great managers are. And so that delta is very true in terms of the difference between mean performance in private equity and top quartile is often going to be 6 to 10 percentage points of IRR. So that's annually, right? Compounded. And probably, half a turn from a multiple standpoint, right? It's a 2x return versus a 2.5x. But it really ends up being building relationships, having an appropriate capital base. Because if I showed up with a $5 million check, Sequoia, one of the greatest venture firms in the world, is not going to be interested. If you have a $50 million check, right, and know the team, know the people for a while, you actually matter, right, and can be a meaningful partner for them. And then there's many ways that you can help them. And certainly I've done it through my whole career, and the team here has done it. But you really kind of try to build those relationships with the best investors in the world, become a partner of choice. And where now many times some of those leading firms and the founders of these firms refer the next generation of great investors to us. And so that ends up being, an important piece where through relationships and building those relationships through performance, right, and by being a great partner, you can access the best of the best. In capture, the goal is to obviously kind of be an all top quartile managers. We never will be. There's going to be some managers, right? And even the managers that many people know about, maybe top quartile consistently, but not in every fund. And we're not going to be perfect, but you can put yourself just pattern recognition wise, history, domain expertise, understanding of the business in that position where you really can, opt in and choose to partner with many great managers.
You mentioned there, Lane, a few times about the importance of relationships and people. What do you think is one of the most important qualities that you would be looking for in a private equity investor?
So I think it always starts off with the people, high integrity, right? In high quality people, because these are long-term relationships. When you invest in private equity, each of these funds is technically 10 years, usually becomes 12, but we want to invest in a series of funds. And so you're really kind of, number one, betting on the team and the people. And so with that, you want a great culture. Number two gets into the performance, right? Historically, has their performance really been, back to your comment earlier, top quartile, right? Top decile even, right? Or top 1%, where you really want those gifted managers. And when you look at the universe, there's only a handful of those great investors, and you want to partner with the best. But then you kind of get back into not dissimilar to evaluating business, right? What are the characteristics that can be a moat, right? That are unique to that firm, that provide a greater real edge. Usually that is domain expertise. It could be hopefully from an investment standpoint and an operational standpoint, but going deeper. What is their edge? Is it a sourcing edge? Is it an operational edge? Is it a strategic edge? So you really want to peel all of that back, right? In terms of when you're evaluating managers, to make sure that you're backing the right people with their unique and differentiated strategy in those that are really kind of playing in a less efficient part of the market with a proven ability to capture inefficiencies in more efficient markets. And so when you have that, you can really underwrite future outperformance, right, in terms of these managers. And so it's really not dissimilar to investing in a company, Tracey, in many ways, because that's really kind of you're partnering for the long haul and you get married to some degree. Mm-hmm. And so the diligence, the referencing, takes months, not weeks, in terms of when you're partnering with new managers.
How important then is diversification when it comes to private equity investing? When you're, say, investing into a private equity fund, how many names would you be typically looking for in a fund like that?
So when we kind of raise a vehicle, a pooled vehicle, as you know, in a pooled vehicle that we would raise, it would probably be 40 to 50 managers. Mm-hmm. So there's actually great diversification. When you think about each manager, if they're buyout of maybe 10 companies, 15 companies in the portfolio, if it's venture, could be 20 to 30. So there's actually hundreds of companies in one of our portfolios. So enormous diversification. Some people get worried about venture capital, there's volatility. The way we do it, and certainly the way we did it at Harvard Management Company, is when you do it that way, right, you do have diversification when it ends up mitigating the volatility, but you still end up kind of getting the outperformance. So on a risk-adjusted return standpoint, it ends up being highly attractive. So we end up having a very diversified portfolio of managers, but you want buyout exposure, growth equity exposure, and venture exposure, and not all tech buyout exposure. Hence a number of managers, right? A broader number of managers. I'd say the other thing too is where the inefficiencies exist in private equity, mid cap, small cap, micro cap, that lends itself to having more managers in your portfolio. So all of those things are part of what makes up a differentiated private equity offering. The last piece is a very important piece is co-investing, where you partner with your managers on direct deals where they're leading an investment, And, in each of our funds, we'll end up having, addition to the funds, generally 40-ish co-investments, where with our managers are going to kind of invest in something they really believe in. It's a company that's high conviction. And we've got investments in a variety of the leading companies in the venture capital space that everyone would know. But our manager may have done the seed round and they'll come to us saying, listen, they're going to raise at a $5 million valuation. You can partner with this no fee, no carry. And so that's an important part as well of just kind of creating more diversification and structurally kind of having a little bit more exposure to some of the best ideas in our manager's portfolio. So our portfolios end up being very diversified. Some would say maybe over diversified given the number of companies, but the returns are still very compelling, right? While a diversified portfolio, so you get the benefit of great returns and also mitigating with a diversified portfolio meaning lower volatility.
So that co-invest idea is interesting, isn't it? So that's basically investing side by side with the manager into the company. You talked about inefficiencies in the private markets. And one of the reasons why it's inefficient is the availability of data. So data, I'm guessing, is one of the most valuable things that you would own of all of these private companies. Do you manage a database of all of these private opportunities? How big is that database?
The database is very large. And once again, because we've been in this market for a long time, and I've personally been in this market for a very long time, but our database is very robust because not only do we have the managers in which we invested, but we get pitched by every manager
Right.
in the world. And so once again, the benefits of having a pretty big checkbook, everyone looks at us and views us as a very attractive partner. So we get pitched by everybody. So we not only have the data of the managers we have, the data of everyone who's pitched us. And so you end up having a very deep database. That being said, there's also industry data available, right? That's kind of benchmarking that we use from a benchmarking standpoint. So with our data, industry data, and with all of that, you can be very transparent about how we're doing relative to peers in the industry. And what we want to do is just like our managers, we want to be top quartile. I say, Tracy, the one other thing I'm going to follow on the co-invest point that you made. Co-investing, as I kind of helped rebuild that at Carbon Management Company, is incredibly important because it's a way to create structural alpha for our clients, for our investors. Because if you take away fee and carry, and most co-investments are made no fee and carry, you take away fee and carry from mean performance in most kind of vintages of private equity, just the fee and carry difference ends up being top quartile. So if you do things no fee, no carry as top quartile, I view that as structural alpha. But by being a great partner, having a reasonable check that you can write, and getting the first call on co-investments, and we do kind of 20 to 30% of the co-investments we see. So we've got a very high bar for co-investments. But with that, you put yourself in a position where just structurally for our clients, we can kind of create alpha. And then if we're in the right managers, which we believe we are, and then choose the right co-investments, there's additional opportunity in terms of value creation for our clients. And I think that's kind of the sweet spot of private equity. So co-investment's an incredibly important part of a program, but it needs to be done very well and thoughtfully.
That's a really good point. Thanks, Lane. You mentioned there that it's important that you want to become a partner of choice. What does that mean for you? When somebody there's an opportunity to invest, what does it mean for you to be a partner of choice?
And sometimes I think real time examples are great. Are very helpful. So recently there's a firm that's spinning out of a larger private equity firm. And oftentimes we like these types of plays, but very proven, a great track record within this firm. They wanted to keep this person, but this person was entrepreneurial and had another colleague they wanted to spin out. And so we met with them. We're going to be an anchor partner for them. But in that process, they came and sat down with us and we're talking about, okay, how do we build our firm, right? How do we think about this? And we can focus on things like back office. We help from an operational due diligence standpoint. What do you need? What should you insource? What should you outsource? But even from a partner standpoint, Tracy, we've been around long enough, and certainly my background with endowments and family offices, the team here's background in the multifamily office space and our network, we can help those types of GPs with who do you want as investors? Who are the best investors? And so we try to punch above our weight by being a really value-added partner. That can then be, okay, who do you want to talk to? We help with introductions to other people we like to partner, who I think will be great partners for them. It can also be into, hey, we're putting together our pitch deck, right? Of like, here's how we're framing things. Here's our track record. but we'll help people refine their presentation materials, not just for us, but for other people as well. And so, but you need to be deep in the sector. You need to have been around a long time. You need to have respect, from the GPs, but you can really provide value in a lot of ways. Sometimes there's ways that ends up cementing the relationship, right? To be a first call and early call and co-investments, but it also gives you greater insights into the firm, in the kind of how things are going, the people. And so I think, those are ways though that we try to build those partnerships and become a partner of choice. And once you do that for a number of firms, as we've done historically in the past, and I've certainly done personally, then those firms, when someone else really talented is spinning out, they then make the introduction to that next generation. And so it ends up being a bit of a flywheel, but that's not built in 2 years, it's not built in 5 years, it's built in decades. And so like that's the benefit of once it's built though, it does become a bit of a flywheel.
Just approaching the last couple of questions, Lane, but I'm interested, I'm assuming that your clients, their portfolios are not 100% private markets. How do you blend this fascinating part of investing with public markets and other asset classes?
So I think Tracey and I chatted a little bit, I've chatted with some previously, and I think philosophically we're in the same place. It really ends up being what's the right fit for clients, right? I mean, illiquidity and using that illiquidity is the advantage people have, but you want to use it thoughtfully, right? We think about, as you do, the illiquidity budget, the fee budget, right? And after-tax performance, right? And so with that, it ends up being what's the right fit. So for our most aggressive clients, that can kind of be in the 30 to 40% range, right? Even in private equity, you can kind of edge a little bit higher than that when you kind of take into real estate net resources. But rarely does anyone go north of 50. But that certainly depends on the scale of your capital, your liquidity needs, right? And a bunch of other factors. And sometimes it's all about just risk tolerance. Like, how do you feel about things? And so it ends up being very curated. But private equity specifically, right, within our clients, I'd say the average for our clients would be kind of in that 28 to 30% range in terms of private equity. And then there'll be some other areas of real estate net resource and maybe some private opportunistic strategies that complement that.
All right. Well, so last question, Lane. We spoke about how the universe of private markets is expanding and public is shrinking. Where do you see us in the next 15, 20 years? Do you think, how is the private markets going to continue to develop? And is that trend towards shrinking public, expanding private going to continue?
It certainly seems like that is the trend line because you still have, frankly, private equity leaning in and taking public companies private, more so than you see in new IPOs and companies staying private longer. And so I think that trend line continues. But I think what's most important to me, Tracey, about that is with the volume of companies that are private, whether even stay constant, the fact that there's so many companies, right, in growing companies in particular, that are available in the private markets, that is what creates the opportunity set in the efficiencies, right, of finding those great companies that you really can partner with, invest in, and then see their growth, right, to a higher level. As we've discussed, we lean very much into kind of the smaller managers, like the smaller parts of the market. And the great thing is then many times for our managers, the takeout is the larger private equity firms where we have less exposure, but we can kind of build that farm system for moving up. But I believe as we look forward, private equity will continue to be a very compelling place to invest capital. And I think, once again, no one knows, it's the future, but history as a guide, private equity has outperformed over every 10-year period. It's been a great run for publics. And knowing that there's cyclicality in each of these markets, I just continue to believe that private equity will be an interesting place on a forward-looking basis as well.
Fantastic. Well, thank you so much, Lane. I really appreciate that. That unfortunately brings us to the end of today's conversation, but I'm sure there's going to be many more in the future. A timely, I think, look at the relationship between public and private markets. And as Lane reminded us, it's not about choosing one over the other, but about understanding the role that each plays in a well-constructed, forward-looking portfolio. Lane, thank you so much for sharing your insights and experience with us and to our listeners. Thank you for joining us. Thanks, Lane.
Thank you, Tracey, and thank you for your partnership.
Thank you for listening to Escala Perspectives podcast. Be sure to subscribe to this podcast on iTunes. You can connect with Tracey by visiting escalapartners.com.au. Escala Partners is a corporate authorised representative of Escala Wealth Management, which holds its own AFSL. This podcast has been prepared without consideration of specific client investment objectives, financial situation, or needs, and is for general information purposes only. Please don't rely on it for the purpose of making an investment decision. You should seek independent financial and taxation advice prior to making any investment decisions in relation to any of the content considered in the podcast, and consider any relevant disclosure documents. If you require any further information regarding the matters discussed on the podcast, please contact Escala Partners.